If you've just been laid off and your employer handed you a severance package, do not let the size of the check distract you from what you may be giving up, because the most expensive mistake you can make may happen before any money reaches your bank account. It may happen when you sign the agreement. Your employer might give you 5 days, 7 days, or 2 weeks to decide. The document may look official. The offer may sound generous, and you may feel pressure to sign so you can put this experience behind you. But severance is not just a check. It can affect your taxes, employment insurance, pension, health benefits, stock options, retirement plan, and potentially your legal rights. In this video, I'll walk you through 6 expensive mistakes Canadians make after receiving a severance offer and what to do instead. And stay with me until mistake number 6, because it's the one that can quietly turn a temporary job loss into a long-term financial problem. All right, let's get started. Mistake number 1, signing before you understand the release. The first mistake is signing the severance agreement too quickly. Being laid off is emotional. Even when you know the decision wasn't personal, it can still feel personal. You may be shocked, angry, embarrassed, or worried about what comes next. This is not the ideal mental state for making a permanent legal and financial decision. A severance agreement will often include a release. By signing that release, you may be agreeing that the payment settles your claims against the employer. Depending on the agreement, you may also accept confidentiality, non-disparagement, non-solicitation, and other continuing obligations. Once the agreement is signed, reversing that decision may be extremely difficult. So do not assume the deadline printed in the letter means you must sign immediately without advice. A better response is, "Thank you. I need time to review the complete offer and obtain independent advice. Please confirm the signing deadline and whether an extension is available." Then read every document. Do not rely on what's said during the termination meeting. Ask for the complete offer in writing. And look for your official termination date, whether you remain on the payroll, whether the offer is salary continuance or a lump sum, when benefits end, how vacation pay is handled, what happens to bonuses, commission, shares, and stock options, whether you must repay anything, whether the payment ends if you find another job, and exactly what rights or claims the release asks you to give up. The goal is not to create a fight with your employer. The goal is to understand the transaction before you make it permanent. Mistake number 2, assuming the first offer is automatically fair. The second mistake is assuming the employer's first offer must be everything you are entitled to receive. In Canada, there can be an important difference between minimum employment standards, entitlements, and what an employee might receive under an employment contract or other applicable legal principles. The amount can depend on factors such as your province, whether your workplace is federally or provincially regulated, your age, your position, your compensation, your length of service, the wording of your employment agreement, whether the termination was without cause, and how difficult it may be to find comparable employment. Do not use a simple online formula and assume it gives you a definitive answer. And do not compare your package with what a friend or colleague received. 2 employees working for the same company can have materially different circumstances. For example, imagine 2 employees who were each with a company for 10 years. One is 32-year-old and works in a field with strong demand. The other is 59, holds a high specialized senior position, and may need considerably longer to find a comparable work. The number of years is identical, but the situations are different. This does not mean every offer is inadequate. It means you should not determine whether an offer is fair by looking only at the number of weeks in the percentage. Before you negotiate or sign, have someone qualified to review your original employment agreement, any later amendments, the termination letter, the severance agreement, your compensation records, your bonus or commission plan, your pension documents, and your equity or stock option agreement. A short professional review could potentially identify something wrong far more than the cost of obtaining that advice. Mistake number 3, looking only at the salary number. The third mistake is focusing on the headline severance amount and ignoring everything else. Suppose your salary is $100,000 and your employer offers 6 months of pay. You might immediately think, that's $50,000. That seems reasonable. But was your salary your entire compensation? What about an annual bonus? Sales commissions? Employer pension contributions? Group RRSP matching? Health and dental coverage? Life insurance? Disability insurance? A car allowance? Professional dues? Unused vacation? Restricted shares? Stock options? Or other benefits? A package that replaces salary but ignores material parts of your compensation may be less valuable than it initially appears. Benefits deserve particular attention. If your health, dental, life, or disability coverage is ending, find out the exact date. Do not assume you are covered because you are receiving salary continuance. Ask for written confirmation. If you have prescriptions, ongoing dental work, physiotherapy, counseling, or other eligible expenses, determine whether they can be submitted before the plan ends. Life and disability insurance can be even more important. You may have a limited opportunity to convert workplace coverage into individual coverage without completing the usual medical underwriting. The rules and deadlines depend on the policy. Miss the deadline, and you may lose the opportunity. Also examine bonuses and commissions carefully. Does the agreement say you must be actively employed on the payment date? Does it say the severance payment includes every bonus or commission claim? What happens to a deal you completed before termination but closed afterwards? Do not accept vague verbal assurances. If something matters financially, get it in writing before signing. Mistake number 4. Taking the money without a tax plan. The fourth mistake is making the payment decision before understanding the tax consequences. Severance may be paid as a lump sum, salary continuance, installments, or some combination. Those options can produce different cash flow and tax results. A severance payment and retirement allowance is generally taxable. If you receive a lump sum, your employer will normally withhold some income tax. But withholding tax is not necessarily your final tax bill. Your final liability depends on your total taxable income and deductions for the year. Imagine you earn a strong salary for 8 months and then receive a lump sum severance payment in the same calendar year. That could push more of your income into higher marginal tax brackets. The amount withheld by the employer may not be enough to cover the final tax liability. Then tax season arrives, and so does an unexpected bill. Before choosing the payment structure, ask, can the payment be spread across 2 calendar years? Can part of it be transferred directly to my RRSP? How much unused RRSP contribution room do I have? And any portion considered an eligible retiring allowance related to service before 1996? Would a direct transfer prevent tax from being withheld on the transferred amount? And how much cash do I need outside my RRSP to cover living expenses? CRA rules may permit a direct transfer of some or all the retiring allowance into an RRSP or registered pension plan. The non-eligible portion generally requires sufficient available RRSP deduction room. Special rules may apply to eligible service before 1996, but do not automatically put every available dollar into your RRSP just to reduce this year's tax. If you have no emergency fund and no new job, locking up too much cash can create a second problem. You need a balanced tax efficiency with liquidity. A tax deduction is useful. Being able to pay your mortgage but buy groceries is essential. Build the cash flow plan first, then decide how much can reasonably be transferred. Mistake number 5, waiting to apply for employment insurance. The fifth mistake is waiting for the severance issue to be completely resolved before applying for employment insurance. Apply for EI promptly. Do not assume you must wait until the severance money runs out. Do not assume you need to have your record of employment in your possession before beginning the application. And do not assume your employer will handle the application for you. EI rules can change, including how separation payments are treated. At the time this video is being recorded, a temporary federal measure generally provides that certain separation earnings are not deducted from EI benefits when the relevant benefit period or allocation begins between March 30th, 2025 and October 10th, 2026. But eligibility still depends on your circumstances, and you must still apply and accurately report the money you received or expect to receive. Do not try to decide for yourself whether the severance counts. Report the information and allow Service Canada to make the determination. Delaying the application can put benefits at risk. While you're dealing with EI, confirm that the information on your record of employment is accurate, including your last day of work, the reason for separation, your insurance earnings, and any amount paid on termination. If something appears wrong, raise it promptly with your former employer and Service Canada. EI should not be viewed as an afterthought. It is part of the transition plan. Mistake number 6, making permanent money decisions while you're still in shock. The 6th mistake is allowing a sudden job loss to trigger a series of permanent financial decisions. A severance check can create a dangerous illusion. Your regular paycheck has stopped, but your bank account may suddenly hold more money than usual. That can make you feel temporarily secure. You may decide to pay off the entire mortgage, invest the full severance payment immediately, buy a vehicle, start a business, make a large RRSP contribution, take the cumulative value of a pension, help family members, or take several months off without calculating the cost. Any of those decisions could be reasonable. The mistake is making it before you understand your new financial runway. Start with a transition budget. Calculate your essential monthly spending: housing, food, utilities, insurance, transportation, debt payments, childcare, medical expenses, and minimum personal spending. Then calculate your reliable income: salary continuance, your spouse or partner's income, employment insurance, investment income, and any other dependable cash flow. Do not count on getting another job in 30 days just because you have a strong resume. Plan for a conservative unemployment period. If you expect to find work within 3 months, ask what happens if it takes 9 months. That does not mean you should panic. It means your plan should survive an outcome that is less optimistic than you hope. Next, create 3 buckets. Bucket 1 is immediate cash. This covers regular expenses and near-term obligations. Bucket 2 is your transition reserve. This gives you time to find the right position instead of accepting the first available offer because you're running out of money. Bucket 3 is long-term capital. Only money that is not needed for the transition should be considered for long-term investing, paying off a mortgage, or other permanent uses. Be especially careful with pension decisions. Depending on the plan, you may be offered choices such as leaving a deferred pension in the plan or transferring cumulative value to a locked-in account. Those choices can involve investment risk, interest rate assumptions, taxes, survivor benefits, guarantees, inflation protection, and access restrictions. The largest number on the pension statement is not automatically the best option. Once a pension election is made and the money is transferred, changing your mind may not be possible. Job loss creates urgency. Good financial decisions require perspective. Give yourself room to separate the emotional event from the permanent decisions. So what should you do before you sign? So if you have a severance offer sitting in front of you, here is your checklist. First, acknowledge the offer, but do not sign it immediately. Second, confirm the deadline and request additional time if you reasonably need it. Third, gather every relevant document: your employment contract, the termination letter, the severance agreement, bonus and commission plans, pension statements, benefit booklets, stock options or share agreements, and recent compensation records. Fourth, have the agreement reviewed by an employment lawyer in your jurisdiction. Fifth, ask your former employer for a written breakdown of every benefit, including in the package. Sixth, apply for EI promptly and report the severance accurately. Seventh, confirm your RRSP room and estimate the tax consequences before choosing how the payment will be made. Eighth, build a conservative transition budget. And finally, delay major irreversible financial decisions until you understand how long the money may need to support you. Being laid off can make you feel as though control has been taken away from you. But the decisions you make after the layoff are still yours. You cannot always control when a company eliminates your position. You can control whether you sign before understanding the agreement. You can control whether you ask the right questions. And you can control whether the severance becomes a short-lived check or the foundation of a well-managed financial transition. If you've received a severance offer and you're unsure what to do with the money after obtaining the appropriate legal advice, this is exactly the type of financial transition that deserves a written plan. In this video helped you, subscribe to Money in Motion with Brett. I make practical videos for Canadians dealing with inheritance, retirement, career changes, severance, and other major financial decisions. And in the comments, tell me which part of a severance package you would like to find out more about. The legal agreement, the taxes, employment insurance, or the pension decision. Thanks for watching, and I'll see you in the next video.